Hello and welcome to Module 4 of the Rent-to-Own Cash Cow formula. And today we are covering structuring the deal and drafting contracts for a win-win. I know there are a couple people who couldn't make it today, so be sure to email with any questions that you have. All right, the replay will be public within the portal, of course. Type your questions in the chat box or wait until the end of that segment. Mute your mic other than in question period. And the membership portal is there for replays, transcripts, documents, contracts, all of that. And of course, please refrain from sharing and protect all these documents. On today's menu, we are structuring a win-win deal to maximize profits and protect all parties. We are going to go in detail about the required contracts and the key lease terms that are different between a regular lease and a rent-to-own lease. The option and option disclosures will be fully explained, and make sure you grab your copies of the contracts so you can follow along. Let's get right into structuring the deal. Just a few reminders for how we need to structure. We must charge at least full market rent. So if the range of rent is between $2,000 and $2,200 on a rent to own, personally, I'd be going for that $2,200. And then anything above that can go towards your option payment. So that is a banking requirement. And of course, you want to make sure that the rent, or the total monthly payment, I should say, the rent and option payment cover your costs. So this applies to both tenant first and property first. Sometimes in property first, you won't have your costs fully covered, especially if you've got the deal with low money down and it's a fast repayment mortgage. Then I've had those where it doesn't cover the full payment, but of course we're getting accelerated payment and we've put low money down. So it's not as critical, but with tenant first, it better be covering your full costs. And the maximum house budget that we are going to allow for the tenant is determined by the tenant's payment budget and their debt coverage ratio. So of course, we go into great detail on qualifying and what that maximum house budget is in module 3, but for that maximum house budget, the tenant's payment budget and their debt coverage ratio has a huge impact on this. And we must ensure that the tenant will have the required down payment by the end of the term. So if they are going to need a 10% down payment, then we would take the whatever the shortfall is between what they have now and what they're going to need and divide that up over the remaining months of the term, because it's our responsibility to make sure that they are on the right track and we're setting them up for success. So we determine the length of the term of the contract based on the tenant's needs, and their monthly budget and their required down payment is a huge part of that. So it's not, there are other factors that determine what their maximum house budget is, but this really goes to determine the length of the term. So if you anticipate their score could be less than 650 by the end of the term that you've both agreed upon, they must have a 10% down payment. So if they're not going to be able to save a 10% down payment in the short term that they want, you're going to have to convince them to go longer. So it's a real negotiation between what's possible and what they want, and we have to try to make that work. If their score could be above 650, then we can allow for less than a 10% down payment as the goal. Ideally, they have 10%. That makes it way easier for them to get a mortgage. But if their score is going to be above 650, it's more likely that they will be able to qualify with less than 10% down. But also keep in mind, you could be faced with a renewal, because banking guidelines, insurance guidelines could change, and perhaps the new magic number is 670. So we do have to keep in mind that if we're aiming for the bare minimum, there could be the possibility of a renewal. And that's something we also want to explain to the tenant if we're setting it up based on bare minimums. So based on the tenant's total housing budget, so rent plus the option payment, we do the math to determine the term required to achieve that required down payment. So as I said, we'll do a specific example in a few minutes, actually. The credit issues, as I've mentioned before, some rent-to-own operators specialize in working with tenants with credit issues, but I do not. And part of the reason for that is because I think that because it's our responsibility to set up a tenant for success, and if they have current credit issues, that's a bad sign. That says that maybe they're not responsible enough for this step. And how can we really say we're setting them up for success if they have current credit issues and current bad habits? I think that's a hard thing to prove. So blips in the past are fine, but bad habits and current issues are not. And current good credit usage adds to your score and offsets the negative effects of past bad credits. So the more good you have right now, the more it's going to offset that bad and just push it down into mattering less and less. And of course, everybody wants to know, how long will it take to improve credit? Well, it depends, and you have to look at the specifics of the credit report for that. So first question is, when will all those negative trades and collections and everything drop off? Remember that it's 7 years for something to drop off the report from the day it became delinquent or late payment or whatever it is. It takes 7 years for that to drop off from that first date. So if you have a bunch of things that are, and we've had clients like this before, where there are a lot of negative things that are going to drop off their report within 1 to 2 years, and then their score is going to rapidly increase. So that is something that is a huge factor, is if something's going to drop off right away. And when was the most recent negative? If they had negative trades, late payments, all of the collections, all of that within the last year or two, that could be an indicator of bad habits. So that's something to watch out for. But it also means it's going to take longer for their credit to improve. It's going to take longer for those things to become old and not mattering so much. And how many positive trade lines do they have versus negative? If there's only one bad account that they've got in the past and they've got 2 current positive lines, then that's going to have a bigger impact, those 2 outweighing the 1 in the past. And when will their debt be paid down? If they have high debt usage, and that's a big factor, then when is it going to be at that magic 30% of credit limit level? So as I've said before, in some cases, they have 2 car loans and 1 will be paid off in less than a year. And that's going to dramatically reduce their debt payments, and not so much their debt level, but it'll reduce their debt payments. But also, if it's revolving debt, we want that percentage to be low. How long is it going to take them to pay down those credit cards? And if it's a confusing file and there are a lot of factors that are maybe conflicting or just too many things to think about, that's when I bring in my friendly neighborhood mortgage specialist and I consult with her. And of course, if you're doing lots of business with her, giving her lots of referrals, then she's going to be happy to help you out because she knows that more referrals will be coming from it. Just a reminder of how credit scores are calculated. The most important factor is the payment history, the bankruptcies, late payments, past due accounts, collections, judgments. So that's a huge part of the score. And that's why we want any negatives like that to be long gone, to be years past. And amounts owed, the proportion of the balance owing compared to the total limit available, that also has a huge impact on our scores. So we want our tenants to have those revolving credit limits down below 30%. So again, we need to look at, when is that going to happen? Now let's look at an example of the deal structure. So today the tenant has a score of 630, and we anticipate it could easily be above 650 within 1 year. So that means credit-wise, they should be able to qualify in a year. They have $10,000 now, and the final price that we've determined for the house, if it was a 1-year term, would be $350,000. So the tenant needs $17,500 for a 5% down payment. So they need $7,500 more than they have. But remember that with insured mortgages, they have to also have savings for down payment, or sorry, for legal fees. So let's round that off to they need $10,000 more to cover the remaining down payment and the legal fees to get 5% down. Now, if their stated total budget is $2,300 and market rent is $1,900, we need to charge the market rent of $1,900 and their total payment will be $2,300. So that is $400 per month available for the option payment. Now, that $10,000 divided by $400 per month means that we need 25 months of saving at that rate for them to have all the money they need to do the 5% down payment plus legal fees. So that's not a one-year term. And the next question then is, if we're doing a 2-year term, can that final price stay at $350 or will it need to increase? Now, if we do consider a 1-year term, the tenant would need to pay $833 option on top of the rent in order for them to have the required 5% plus legal fees within 1 year. That would mean their total payment would be $2,733, which is $433 higher than what their monthly budget was. So is this doable for them? Do they have room to flex their budget and afford that extra $433 a month, or would a longer term be better for him? So really we have to consider, is it better to have the higher payment and shorter term versus the lower payment, longer term, and possibly higher final price? So these are the discussions we have to have with the tenant to determine the best solution for the tenant that also works for you, of course. Now, it would seem to me a 2-year deal makes more sense for monthly payments, just off the top of my head, but the 2-year deal usually means a 2-year price. I don't normally want to keep that price at a 1-year price for 2 years. Because generally speaking, we do increase the final price every year in the program. That includes for renewals. So in this case, the final price could increase to $357, which is not that much more. But it could be a lot more depending on what the market is doing. If it's a rapidly rising market, we don't want to stay at only $357. It might end up being $370. It really depends on the market. So again, which is the best alternative for the tenant? And that's the kind of structure you have to play with for every deal that you're looking at. And again, make it work for everybody. For a final price, to determine price increases, we have to look at the local housing market and its direction. So is it flat? Is it rising? Is it falling? And what rate is it rising at? What is on the horizon for the local economy? Are there major projects coming up that are going to rapidly increase the economy soon? So those are all things we have to keep in mind when we're figuring out at what rate we're going to increase the price. So looking back to Calgary during the boom of, when was this? Oh my goodness. We'll say 2013. I can't remember. But we anticipated that the price would easily increase 9% per year and that would be easily doable. But we set our appreciation at 5.5% per year. And that was because we wanted it to be an easily achievable value for the tenant, and the tenant gets a deal on the property. They get some free equity. And that sets up a win-win. The other factor that I don't have written down is that we didn't really think it was going to be easy to negotiate a 9% per year increase with the tenant. That would be really pushing it. And even though it ended up being more, we didn't think that that was possible. But hey, if you can negotiate a 9% increase per year when you are fairly positive it's going to be 9%, then good for you. I didn't think I could do it. Now, in a flat market, of course, or falling market, obviously, we are going to say no to tenant first rent to own. We only want to pursue tenant first in a rising market or maybe when it's just poised to start rising, that's when interest starts to peak, and people start giving you phone calls for that. But when it's still flat with no prospects yet, that is not an appropriate time for tenant first rent to own. Now with property first, you could add a modest price increase in a flat market. So if the current market value is $350, your final price in 2 years could be $356. So just a really modest increase. But even if it doesn't increase, it won't matter. You can reduce that price, because in a flat market, your money is made by not having to discount the property, and also by not paying realtors fees, and of course your mortgage pay down. So in a flat market with property first rent to own, you don't actually need a markup. It's just a bonus. So you can negotiate the best you can negotiate. And if you have to reduce it, that's fine. So even if the price does only increase by $6,000, so let's say we do make it work, but you're actually making 30 because of the lack of the discount and the realtor's fees. And that's not even including the mortgage pay down there. So property first works just fine in a flat market. And of course, we always want to negotiate the highest possible final price, and it can be whatever you want as long as you both agree. If you can get that 9% per year appreciation negotiated, then do it. And you can always adjust it down later, and then you're a hero. Now, do I prefer 3 years? No. I prefer deals that look like they can be done in 2 years, and often we will need to, or not often, but sometimes we will need to renew for a 3rd year. And that's why I'm always aiming for a 1 or 2 year deal, because there's always the chance of renewing, and it's difficult to anticipate 4 years in advance. So if you start with a 3 year deal and have to renew, now you're into that 4 and 5 year deal. Final price. As I said, reducing the price, if required, makes you the hero, and the tenant will be much appreciated, very appreciative. And if the numbers still work for you, you're still getting a good return on your investment, you're still getting a good return on your time, then why wouldn't you do it? And if the numbers don't quite work for you, plan B is to negotiate a payment plan with the tenant. Now, we're going to cover payment plans more in module 6, but just to give you an example, this is a real deal that we did. The CMHC appraisal was $57,000 below the agreed price. And both the tenant and us agreed that was completely ridiculous. It was ridiculously artificially low. So what we did was we reduced the price by $7,000 just as a goodwill gesture. Remember, we're not obligated to reduce the price, but if we can, and it helps the tenant and sets up that win, and they are appreciative of it, then that just makes sense to do. Now, that meant that they had $50,000 still owing, and we set up a payment plan of $1,000 per month for 50 months. And because you're dealing with a higher quality tenant who is interested in making this work and getting home ownership, they paid in full. Absolutely on time, every month, paid in full. We got our extra $50,000. So that is something that is vastly different than regular rentals. If a regular rental tenant owes you $50,000, you will never see that money again. But rent to own is a little bit different. Now, with final price, some thoughts that I have are to leave some money on the table. As I said, with that 9% increase, we knew it was going to happen, but we set it at 5.5 because that made us enough money, and it really set the tenant up nicely. And we knew we would get a fair profit based on that, and our money partner would get a great return. So why not leave some on the table for the tenant whenever you can? And this sets the tenant up for success. They get free equity when they buy, which is awesome for them. But more importantly, it's less risk for the bank when the appraisal is substantially higher than the agreed price. They have less risk because they're lending less on a property that's worth more. So less risk for them means they're going to be more likely to approve the mortgage. And Then also, as a side bonus, the tenant thinks rent to own is the best thing he ever did and gives you amazing testimonials. And I do recommend that you get testimonials from your rent to own clients to put on your website. So video is best, but written will do as well if they just send you an email. But if they do a video, then of course you can take little excerpts from that for written testimonials as well. So video is definitely best. Now with payment plan, what is the hook? I don't understand the question. And we are at question time, so if you want to ask me, I don't understand what the hook is. So I will tell you, with the payment plan, you can't have it as a second mortgage. It can't be registered on title because that would go against the CMHC rules. So all it is a promissory note, and it's all set up. And what my promissory note says is that if they don't pay as agreed, then we will register it on title. Okay, so that should answer the question then.
For the down payment that you choose for them to pay, that's based on the end price that they're going to pay when the term is up, right?
Yes, so we look at what their anticipated credit score might be. So if it looks like they're going to be in the high 600s, then they can have less than 10% down. If it looks like they might be only close to 650, then we're going to require that they have at least 10% down. So then that would be 10% or 5% of the final purchase price. So if we're agreeing on 400,000 as a final purchase price and it's 10% down, then they need 40,000 in total plus the 2,000 for legal fees that the insurance company requires that they have in savings as well.
Okay, and do you usually shoot for CMHC insured mortgages?
Most people buying today are going to have an insured mortgage. There are very few that will have the full 20% down, but some do. We have had a handful of people that have had the full 20% down. But yeah, usually you're going to be dealing with insured mortgages. So that's why you have to keep all the CMHC guidelines and requirements in mind. Okay,
awesome.
All right, let's dive into contracts. So these are the contracts that you will have, and we're discussing most of them, and they're all in the portal already. The intent to lease, the lease, the option agreement, the option disclosure, the certificate of independent legal advice, and then these two we're not discussing today, utilities agreement and utilities information release. They're pretty straightforward. The utilities agreement just says you're responsible, Mr. Tenant, for paying utilities and putting them in your name and paying them on time. And the utilities information release says that we have permission to call the utility company and check up on you and make sure that you're paying your bills. So that's pretty straightforward. So we're not covering those today, but they're in the portal. And this is important. We want to send drafts of all the contracts to the tenant before we, proceed. So once they're approved, once we've got their final budget figured out and we say, okay, well, here we're approving you for a maximum house price of $400,000. Here's what it'll look like. If you bought a house of $400,000, then here's what your monthly payment would be. Here's what your initial payment would need to be. Here's what all of that stuff. We tell them all of that. Here's what your term is that we're recommending based on your needs and your credit situation and financial situation. And now we're going to send you draft copies of all of the contracts so you can read through them, so you know what you're getting into. And we highly recommend that you take them to independent legal counsel to get independent advice on these contracts. So this is the time after they've been approved, we send, and I send blank contracts with draft as the watermark. So it's nobody can fill it in and pretend it's real. So it says draft right on it, on a watermark on the back, and or on every contract, and they can review it. Then they give you their okay. As I say, we do recommend they take it to independent legal counsel. Whether they do or not is that's an individual thing, and I find that most people don't. But also, the contracts, the way they're written, are pretty straightforward. So most people should be able to understand them completely without the help of legal counsel. We still advise them to get legal counsel. And this is the time to do it before you send them out with a realtor, before you take any money or anything like that. So now the timing after they've been sent the drafts, and this applies to tenant first, because there are a couple extra steps, of course, with tenant first. So we send them the intent to lease, and they sign that and send us the application fee. That must be paid and signed prior to us sending them out with our realtor. And of course, as I mentioned, the deal itself is discussed before any offer is made. In fact, before we send them out with, or before we even send them out with the realtor, we discuss the basics based on their maximum budget. But then once they've found a house they like, we take the list price of that house and we run the numbers and we tell them, okay, if we were paying full price on this house, here's what the deal would look like. Here's what your final price would be. Here's what your monthly payments would be. How does that sound to you? And if they say, oh, that's awesome. Well, now we can make the offer and negotiate our best possible price. And then we would send out once we've negotiated the best possible price and have the offer to purchase signed for the house they've chosen, now we run the numbers that we'll actually be using, and we write them up into the contract with the final actual numbers of final price, rent, how much is going to option payment, all of that. And we write those up into the contracts and send them off to the tenant. So again, this is after we've got the deal signed with the seller of the house. And those contracts have to be signed and returned. And some of the option money has to be paid prior to condition removal. So that tells us, yes, they're absolutely serious. They are moving forward. Now, some rent-to-own operators require that all of the option money be paid prior to us removing conditions on the house we're buying for them. We don't do that because there's just this tiniest gray area where if they are paying all of their money before we are even paying our second purchase deposit, and certainly we're not paying the full down payment. So the tenant has paid all their money to us and all we've paid is the little tiny initial purchase deposit. Then there is the small argument for the tenant having a purchaser's interest or an equity position, because it could be seen as them supplying part of the down payment. And in fact, I do know that some rent-to-own operators use that as part of the down payment. Well, if you're using the tenant's option money as part of the down payment, there is an argument for them having an equity position. So what we do is we require a portion of the option payment due before we remove conditions. And then we supply the full deposits and full down payment, us and our money partners, of course, to buy the property. Then after the conditions are removed and before possession, the remainder of the option payment must be paid. So they don't get the keys until all the money is paid for first month's rent and the full option payment, but the timing of it is flexible. Now, we have had a couple people pay the full amount early, and I'm not going to say no to that, but we don't require it. So it's a very small distinction, but it just takes all the gray out of it. So that's why we do it. Here's the intent to lease contract. Received from the tenant, hereinafter referred to as the applicant. Oh, so sorry, I should say received from the applicant, hereinafter referred to as the applicant, the sum of $1,000. That's the number we use. You can use whatever number you're comfortable with, which upon acceptance of this application by QD HomeQuest Incorporated is an application fee. Now, this is important. This is the rights to cancel. So they can still back out of the deal at this point. So the applicant has the right to cancel this application on or before the sooner of A, within 48 hours of signing this intent to lease, B, within 48 hours of remitting the application fee, or C, upon QD HomeQuest Incorporated signing an offer to purchase a property. And in any of those cases, the deposit is fully refundable. And again, that's the sooner of those, because we have had cases where the applicant has signed the intent to lease, given us the $1,000, we're writing an offer that same day. So in that case, us writing an offer is the soonest of the three. That means as soon as we write that offer, that money is now non-refundable. So in any case, once QD HomeQuest Incorporated has signed an offer to purchase a property chosen by the applicants for a potential lease option with QD, the application fee is deemed non-refundable, as I just said. And after this 48-hour period, this application fee is also deemed non-refundable. Upon the successful completion of the lease option transaction, the application fee will be applied or credited towards the option payment of the option agreement. So the $1,000 application fee is part of their option payment once the option is underway. And if it doesn't go, well, then it's just an application fee. All right, so now there are a few differences that we have between rent-to-own leases and regular leases. Now, I know that some provinces have a set lease that they cannot change the terms. Same way with purchase contracts, you can't really change the terms of a purchase contract. There's the separate section though for additional terms. And that's where some of these things can go in to a lease if you're in a province like Ontario, where they have a set form that you can't alter. And otherwise, you can put some terms on an addendum to the lease. And also some of these are in the option agreement, because option agreements fall under contract law. So it has nothing to do with the Residential Tenancies Board. All right, so the key lease terms. First of all, it's pretty much always fixed term. Even if your mortgage is variable, you want the lease to be a fixed term lease, not month to month. And especially if your mortgage is fixed, because you're aiming for your lease and your rent to own term to match up with the underlying mortgage. And this of course applies to tenant first. You're going to usually sign into a mortgage that matches the anticipated term that the tenant will buy, so you can avoid mortgage prepayment penalties. But in property first, I'm also always aiming to match those up, again, because I want to avoid prepayment penalties. Possession. This is important because there could be delays. So the clause states, if the landlord is unable to deliver possession of the premises at the commencement date established in clause 2, the landlord shall not be responsible for any damage caused thereby. Because in a lease, of course, we're saying, oh, you get possession on December 15th at noon. Well, if you're doing tenant first, that won't always happen. So if and it's a good idea actually to, in tenant first, not to set your tenant's possession day as your closing day, because it doesn't always work out. So I normally would put the tenant's possession day a couple days after the scheduled closing day. And then if we get the property on time, we can always give possession to the tenant early, and they would just need to set up their utilities earlier. So the tenant agrees to pay the landlord a security deposit of $0. In provinces where there are no security deposits allowed, this is a moot point, but here we can charge security deposits, but we don't, because we want all that money that the tenant is bringing in at the start of the option to go towards the option. So there's no silly refundable security deposit, it's all option payment. The tenant shall be responsible for all repairs, maintenance costs, and service charges relating to the premises, the property, and grounds, the appliances, and the furnishings. And again, in some provinces, you cannot make the tenant responsible for repairs in the lease. It wouldn't be allowed. In Alberta, the tenant, you can make the tenant responsible for minor repairs, but major systems are still the responsibility of the landlord. But we have another clause to cover that. So if you're in a place where the tenant cannot be made responsible for repairs in the lease, again, you can have that in the option, because contract law is different. And the tenant may paint, install wallpaper, or otherwise redecorate or make alterations to the premises with prior written consent of the landlord. All costs for any redecorating or alterations shall be fully paid by the tenant. The tenant acknowledges he will not be given any credit or consideration for such repairs, alterations, or decorations. Now, for minor repairs and painting, that sort of thing, minor upgrades, we don't actually require written, an official notice. if somebody is planning on doing something like replace countertops or something, well, it's nice to give me a heads up by email or text. That's all the written notice I need. And because the thing is, it's still our property until they buy it. So I do like to have a heads up, and especially to consider if it's something like tile, where maybe they don't have the experience to do that, then I want to have that discussion with them. So that's why we still want to be kept in the loop of what they're doing with the property. Now, for major repairs or alterations, those usually require a permit. So then written authorization is actually required because we have to be giving them a permit. So adding or removing fences, walls, windows, doors, or concrete buildings, or building or demolishing sheds, garages, or other outbuildings. So all of those sorts of things require, and finishing basements is another thing, but that would be adding walls. So yeah, that's something that we definitely need to be involved in. And here's that clause I was telling you about regarding the major systems, that in Alberta for sure, and probably everywhere, the landlord is responsible for the major systems like heating, plumbing, roof, electrical, windows, that sort of thing. So notwithstanding anything herein to the contrary, nothing herein shall create or impose any responsibility on the part of the tenant to make or incur any structural repairs or construction, which obligation and responsibility shall remain the sole responsibility of the landlord. So that's saying, okay, if it's has to be the landlord's responsibility, we're not trying to make it the tenant's responsibility. But if we are making those repairs, then here's the important part. Any collateral expenses or costs shall be paid to added to the purchase price herein, and shall be fully paid by the tenant as a term of the purchase. So we are not violating the Residential Tenancies Act, because we are not saying they have to pay these things, but we are saying if we pay them, then they will pay us back when they buy the property. Now, some requirements for the option agreement. Now, these are bank requirements. Now, this is the important thing to note. Not all lenders are the same. And these requirements, this is a list that a mortgage broker friend of mine gave me that is one lender's list, but it is a very strict one. So that's why I'm sharing it here. So rent payments in excess of market rent are eligible as a source of down payment provided. Now, important part to note that, again, it's in excess of market rent. Now, that is this bank's requirement, but it is in fact every bank's requirement because it is a CMHC requirement. Now, this part is a bit weird that they're connected, but provided the value is based on the sale price outlined in the purchase agreement and not on present value of the subject property. So what they're saying is the option agreement has to have a price agreed, final price agreed from the outset, from day one, and not the appraised value. And again, that is, last I checked, it was a CMHC requirement that it had to be a stated price, not appraised value. And actually, I checked pretty recently. So I'm not sure why they would say the rent payments are eligible as a source of down payment provided the value. They are actually disconnected. So it's poorly written, but that's what the list said. So that's why it's written this way here. But the important thing is rents above market are proof of down payment, and you have to have a final price for the property. More requirements. A signed rent to own agreement cannot be current dated. So they want that agreement to be dated back 2 years ago, not dated today when you're actually selling the property. And they also don't want it to be backdated. That is running foul if you redo everything and backdate it. What you can do if you do need to make changes is you make an amendment to the agreement that was signed 2 years ago, not write up a new one. And provision for the prospective purchaser to be entitled to some refund of the amounts set aside as down payment in the event the sale does not proceed. Again, this is a CMHC requirement, and this bank has adopted it as one of their requirements, which is a good idea because it's going to be required by everybody anyway. So that's saying that we need to have the reasonable amount refundable written right into our option agreement. And this is pretty much a duplicate of that term, confirmation that the purchasers are entitled to refunds of amounts set aside as down payment. And this one's important. Supporting letter of economic rent from a certified appraiser that was done at the time of the agreement. So again, this is one bank's requirement. Every bank can be different. And at this particular time, this was the only bank that I knew of that required a market rent analysis done by a certified appraisal. But I started recommending it to everyone for all of their properties because it could be that CMHC starts adopting this practice and therefore every bank will have to do it. Or it could be that banks will just decide on their own that they need that certified market rent analysis so they can establish what market rent is and therefore establish that we're in proof of down payment turf. So that is something that you probably should do on all of your properties. Get a certified appraisal on the market rent analysis. And registration of the agreement against the property. Now, this is a tricky one because, so what that means is the tenant is able to register on title that they have an option to purchase the property. And the tricky part is it's the tenant that has to register that, not us. So, and I can't force my tenant to go spend the $500 in legal fees to go register this. And in fact, there has not been a single of our rent-to-own tenants that has ever registered the caveat on title showing that they have an option. And it has never been an issue with CMHC or any bank that they've applied with. But the important part is that in our option agreement, we make it clear that the tenant has the right to register a caveat on title. And I think that really meets the bank's requirements right there, just by making it clear the tenant has the right to do that. Now, the option agreement itself. So this is my agreement. Whereas the landlord offers to tenant an option to purchase real property with improvements thereon, and tenant desires to have the option to purchase said property, the parties, in consideration of their mutual promises contained herein, agree as follows. So there's a little bit of legalese. So property subject to option, the real property controlled by the landlord, which is subject of this agreement, is municipally described as, so then you put in the address, hereinafter referred to as the property. The legal description is plan, block, and lot. Term and exercise of option. The option shall be exercised by mailing or personally delivering written notice and an exercise of option fee of, and that's whatever you decide it should be. Our standard is 1 month's rent to the optioner 45 days prior to the expiration of the lease on whatever date the lease is set to expire. The tenant will also provide a purchase deposit in the amount of $100 to certify the intent to purchase, payable to the optioner's solicitor in trust. Now, a couple important points here. That the tenant is providing a purchase deposit for $100, and that's what goes in the initial purchase deposit section of the purchase agreement. So when we start the purchase process, the only thing they have as a purchase deposit is that $100. There's nothing to do with the option payments at that time. The option to payments don't come into play as a purchase deposit until conditions are removed. We'll get more into that. The other important point is that this $100 purchase deposit is going towards the optioner's solicitor, so my lawyer, and the additional purchase deposits, which are all of the option payments, they are held in trust by my corporation. Now, if you don't have a corporation, you'll probably need to move them over to a lawyer, but because we have one, we've never had any issue with us keeping it in trust. Okay, so yes, on the purchase contract at time of sale, $100 is the initial purchase deposit, and their total option payment is the additional purchase deposit on the purchase agreement. And the additional purchase deposit is payable after condition removal. All right, next section. By exercising the option, the tenant states it is his full intention to purchase the property, and the tenant believes the required financing, if any, is in place. Should the tenant not be able to secure financing, the optioner will return the above purchase deposit in the amount of $100 in full without deduction and with no interest. This clause is, or this term is really because sometimes people will, and when I say sometimes, it's rarely, it's there are people who try to exercise the option even though they really have no hope of getting financing yet, and it's just a hassle. So this is just trying to convince tenants to make sure that they have their ducks in a row before they attempt to exercise the option. And of course, the purchase deposit is refundable, not the option payments. So yes, only the initial purchase deposit is refundable. Those additional purchase deposits or option payments are not yet paid. They're not yet part of the sale, the purchase and sale agreement. So they're not paid until after condition removal. So they're not even part of this yet. They stay as option payments until the sale is official. And usually financing is the only condition on the purchase agreements, because the inspection should have been done at the outset if they were doing one. All right, and now these are a couple of key terms in the option agreement. The option is key terms, meaning that they relate back to the requirements that the banks and CMHC have. So option price, the tenant shall have the right to purchase the property for whatever amount. And in consideration for this option, the tenant agrees to pay the landlord an initial option payment of whatever amount before possession. Failure by the optionee to perform all lease obligations in any lease between the landlord and tenant shall constitute default under this option and void all rights of the tenant hereunder. So if they don't pay the rent, the option is automatically void. Now here's another key. The optionee will pay on the same day rent is due an additional amount, X amount, over and above the rent payment of X amount. Each such payment will be by separate check or money transfer and applied to the option credits, and will cease on payment of your total option payment required or purchase of the property. Said additional payments will only be credited to the option if the full payment rent plus additional amount is paid on time. So this is a key because we want to establish that here's the market rent and here's the amount above market rent that is going towards the option payment. And the reason we want it by separate payment, either check or e-transfer or automatic deposit, whatever, we want it separate for the proof of down payment purchases. Now it is extremely rare, but it can happen that the bank will request bank statements demonstrating the rent and the separate payment. So it just makes it much easier for proof of down payment if we insist they keep them separate. The option credits, including the initial option payment, if any, shall be applied to the purchase price only if the option is exercised and the sale closes. If upon attempting to exercise, and here's another key, if upon attempting to exercise the option, the tenant shall fail to obtain financing and complete the purchase transaction prior to the termination of this option agreement, then the tenant shall be entitled to a refund of 20% of the initial option payment that has been paid, provided that the tenant is not in default of any provision of the lease or option agreement at the time. So there's our reasonable amount that's refundable. We've chosen 20%, and that has worked with CMHC. We've had no issues with that. And note that it's of the initial option payment, not of the total amount they've paid. So if they've paid $10,000 for an initial payment, and then they've paid $500 a month for 2 years, only 20% of that $10,000 initial payment is refundable if they attempt to get financing and can't, and they want to walk away. So that means $2,000 goes back to them, and the remaining $8,000 plus everything else they've paid over time is non-refundable. And this is an important point to that too. Upon the tenant's returning possession, a said amount shall be refunded with no interest and less any deductions required for cleaning and repairs, normal wear and tear accepted. So if it turns out that the carpet is ruined and it's only 5 years old, well, they're probably not getting any of their $2,000 back, because we're going to keep that to use for repairs. And again, this has gone through CMHC many times with no issues. If the option to purchase is not exercised for any reason, the tenant forfeits all remaining option credits, and the optioner will not retain all remaining option credits as liquidated damages and not as penalty. And that liquidated damages and not as penalty is an important legal term because, yeah, we're not penalizing them for not completing. What we're keeping the money for is the fact that we're going to have to prepare this property for sale again. We're going to have to do some upgrades and repairs and repaint, whatever, and plus more marketing. So it's going to cover our costs, not as penalty. That's an important legal term. The expiration of the option, the tenant may exercise the option at any time and it shall expire 45 days before the last day of the lease unless exercised prior thereto. Now, and if they don't exercise the option, they lose all rights. The thing is that this term is in there to protect our butts, but really I've never actually used this term where, oh, you're exercising your option 20 days before the end of the term. Sorry, you can't. It expired at 45 days before the end of the term. So this is in there just because it has to be, but that doesn't mean that you suddenly cut them off if they haven't got all their ducks in a row before this time. Early exercise of option. If the tenant requests to exercise the option before the termination date of this agreement, A, the optioner shall not be obligated to reduce the predetermined purchase price, and B, it shall be the optioner's sole and absolute discretion to reduce the predetermined purchase price. So that's important because if they are exercising early, buying the property early, then most likely we will have mortgage prepayment penalties. So we don't want to be reducing the price if we're going to have additional costs. So if let's say they're exercising a year early, and so the price, the extra price increase for that year would have been an extra $7,000. So now the first thing we're going to do is look at what our mortgage prepayment penalties will be. If they are only $3,000, then we may decide to reduce their price by, say, $3,000, and then we keep the extra $4,000 to cover our additional costs. So that's something that is at your discretion. And if the mortgage prepayment penalties were $5,000, well, we probably wouldn't reduce the price at all. So that's why this is really important. And have I ever had an early exercise of option? I think I have, but I can't remember for certain. I haven't had one that was a full year early. I definitely have had one that was several months early. So then it didn't matter, because if it's a few months early, then for instance, if it's 3 months before the end of the term, usually there is no mortgage prepayment penalty. So we had somebody who wanted to exercise, I think it was 5 or 6 months early. And what we told them was, okay, well, if it's up to you, if you exercise now, 6 months early, we will have mortgage prepayment penalties, and that'll be this much money. If you wait for 3 months, we won't have those penalties if it's 3 months before the end of our mortgage. So it's up to you whether you want to rent for 3 more months or pay now. And so that is definitely one factor in there, is when the mortgage prepayment penalty kicks in. And sometimes it's not a factor. The details of sale. If the option is exercised, the sale will close according to the most recent version of the area real estate purchase contract. That's the Alberta Real Estate Association contract. So of course, yours will be for your province. The completion date for the sale shall be 50 days from the date of exercise of option, or such other date as the parties may agree on. So again, the 50 days is just something to have in there because you have to have timelines. You have to have these things in your contracts. But again, we're putting it as, or what we agree on. And that's the more important part. Repairs and maintenance. As I mentioned, sometimes you can have it in your lease, sometimes you can't, but you can always have it in your option agreement. The optionee shall be responsible for all repairs, maintenance costs, and service charges. That part's all the same. And this part's additional for the option agreement, though. Failure on the part of the optionee to keep the property in good repair shall void this option agreement. So if they let the property get run down, if the roof's leaking, whatever they're not doing to the property, not repairing, not keeping it up, then that voids their option agreement. We can get rid of them, take the property back, and get it right again and remarket it. This has never happened, but it's important to have in there to cover your butts, and just in case, because I do know of somebody that this happened to, where the person let the place get really run down. And then what recourse do you have? Well, in this case, it voids the option automatically. So again, the repairs term for me is in my lease and my option, but you can always have it in the option because it falls under contract law, not the Residential Tenancies Act. All right, now here's where the consequences come into play. This agreement will be null and void if the optionee vacates the property or defaults on tenancy or breaches the lease for any reason before the closing date. If for any reason the tenant breaks or breaches or terminates or voids this agreement, including by means of breaching the lease, all option credits shall be forfeited and the optioner will retain all remaining option credits as liquidated damages and not as penalty. And yes, that is in the option agreement multiple times, because I want them to see at least one of them. I want it to be very clear that if you walk away, if you breach, you will lose your money. You're walking away from your money if you walk away from the property. This is an important addition. A standard template will not have this in it. This is one of my clever little additions to the option agreement. And basically it says that any legal fees incurred by any suit or legal action brought about by either party, those fees shall be covered by the optionee, the tenant. And this is important because every once in a while, I mean, money makes people crazy. So if somebody runs into trouble and they have to walk away, and then they go a little loony and decide, this especially happens if you end up with somebody with a little bit of victim mentality, then it's, oh, this happened to me and I'm mad at the world. And next thing you know, you could have a nuisance lawsuit that has nothing to do with what you've done. You've done nothing wrong, but anyone can sue anyone for any reason at all or no reason. So it's good to have this in your option agreement, because then it helps prevent potential nuisance lawsuits, because somebody starts talking a little litigious to you, and you can point out, well, you agreed that you would be paying the legal fees if any legal action was brought about. So do you really want to go down that road, or can we just have a nice little friendly chat? Here's our other key. The registration on title. Optionees shall have the right to register this agreement on title to the property. So whether they actually do or not, that's up to them. I can't make them do it. I'm not going to pay for them to do it. And even if I did pay, that still doesn't make them do it. So, but this covers us to make sure that they know that they have the right. Binding on heirs and assigns, that's just a standard term in all contracts. So you need to have that in there. Entire agreement, same thing. Any questions?
So for the market rent and the option payment, you were mentioning to keep them separate. And do they have to be like, could they still be each an e-transfer, or were you saying to separate them even in forms of payment?
Oh no, they can be two different e-transfers, two different pre-authorized withdrawals, checks. I still take checks. Most people don't use them anymore, but they can. But yeah, it has to be two separate payments, but it can definitely be two simultaneous e-transfers, that whatever works. But yeah, the key is we want it to be separated on their bank statement, rent and option.
Okay, and I guess that helps. Would that help with our accounting too, perhaps, or
No,
is it mainly just for them?
yeah, it has nothing to do with our accounting, because when we receive a payment, so let's say somebody does pay, forgets, and they end up paying the bulk amount, well, then our accounting will just separate it out line by line. So your
Okay.
bookkeeper can take care of that. But when somebody does pay in the full amount like that, then we always want to remind them, you really should make separate payments, because some banks will want to see bank statements showing that this is the option and this is the rent. So we highly recommend that you pay in two separate payments. I know it's a pain in the butt to do two different payments, but it's really better in case the bank needs to see this.
Okay, so it's definitely in their favor to do this for themselves.
We have had one bank, and I can't remember which bank that was. Yeah, but we did have one bank that did require that they requested the tenants' bank statements, and then they also requested our ledger to show that we had matching payments for rent and option,
Okay,
that we had recorded it as such. So yeah, there are banks out there that will require it. So it's just best if they do keep it separate.
okay. Sounds
Right.
good.
Okay.
What's the normal schedules that you attach to the option agreement? Like,
The normal schedules?
yeah, you say the agreement and attached schedules. Or is the entire agreement? So I suppose it's the payment plan or mortgage, the rent and stuff, or is it?
The lease kind of goes with it, and also the option disclosure. Those are the two. I don't specify what they are there, but so it's basically a blanket statement. But yeah, the option disclosure is part of the option in a sense, but it's they do operate independently. But the point here is to indicate that, yeah, there is more stuff. If it comes down to it, then yeah, that option disclosure is part of this, but it's not something the bank's going to need to see, the option disclosure, and nobody's ever asked for anything else. That term is just a blanket term to make sure that anything we need to tie to this, we can.
All right. So but you don't necessarily provide them with the, like, your offer to purchase the property, things like that.
No, our offer to purchase the initial property, no, but it wouldn't matter anyway, because they know what price we're paying for it. So if it's a tenant first, because we base our tenant first deal structure based on the price we paid for the property. So yeah, they are welcome to know the price we paid for the property, because that's what we base the entire deal on, is the price we actually paid. So yeah, I wouldn't mind showing it to them.
Yeah, does everybody do it that way, or do they just base it on the listed price? And
I can't speak for everybody, but
no.
Yeah,
That's
I can't see why somebody would be so sneaky as to okay, well, the house was listed for 450, so here's what you would pay if we paid 450 for the property, and then I end up getting it for 420, and then I still charge them that. That's too shady for me to even think about. So yeah.
All right. Do you find people get confused about this, the $100 deposit versus the 3% or whatever your deposit?
I do have a few questions about it, but generally people see the $100 and they don't even think about it. So,
right.
But what tends to happen is that when it comes down to it, we have had a couple times where the tenant actually neglects to pay the $100. So that's how unimportant it is to them. That's how it doesn't even because it doesn't even cross their mind as being part of anything. So even though it's in the purchase agreement that you have to pay $100 to my lawyer, we've had a couple times where the lawyer says, yeah, we never did get that $100, and I've just said, you just adjust it out, don't worry about it. So as long as the sale is going through, I don't care about the $100. That $100 is just because in contract law, you have to have something of value
Iteration or
changing
something.
hands to make it real, right?
Right.
Yeah.
And this 20% of the initial, have you ever had just, when the option is ending, that people say, well, I never noticed it was just 20% of the initial, or
No, and the thing is that in the we actually had one this year because COVID just kicked these people's butts, and they tried to get financing a couple times and they couldn't, and they just said, we're getting to the point where because the payment's going to be too high for us. Our wages are down so much still from COVID that not only are we not going to qualify, I think we're going to have trouble affording this even as a rental. So they did walk away, but they had legitimately tried to buy it. And we gave them the 20% back with no problem at all. And they left the place in amazing condition. So, but yeah, they never batted an eye at the fact they were only getting 20% back. They were happy to get anything at all. So, because again,
but
I make
just
it very
20% of the
clear.
initial payment, but not all the other payments they made every month.
Yep. Nope. They didn't question it. They were happy to just
Oh.
get something.
Oh,
Yep.
right.
Yep. And as I say, that's the only one I can think of offhand where they were at the point where they tried to get financing and couldn't. Oh, the other one that happened, that was before the refundable portion was required. So they tried to get financing, they couldn't, and they didn't get anything back. But the market had, anyway, that was a whole other story. But yes, we've only had a couple times where people have tried to get financing and can't, and decided, okay, we just can't do this. So yeah. All right.
Right.
Moving on. So now, so the option disclosure, so that was just the option. Okay. So now, oh, we're running slow here. The option disclosures, that has all the key terms to protect us, and it outlines the rights and responsibilities and risks and consequences. And it also gives suggestions for credit improvement, because we want to set ourselves up as being responsible rent-to-own operators that are setting our tenants up for success. Now, the big thing about the option disclosure is that in addition to a couple extra points, it also brings in all the important points from all the other documents, so that it's all in one place. Here's what you need to know about what you're getting into. So that's the big thing with this. And it gets rid of all the legalese, because this itself isn't a legal contract. It's just them acknowledging that, oh yeah, we understand. So we're able to write things in plainer English than is required by some of the standard contract terms. Okay. So the first two big and most important keys are that the optionee tenant hereby acknowledges that he is a tenant with an option to purchase the leased property as described in the option, and that the tenant is not a buyer with equity, nor is the optionee creating any equity or any rights other than those as set out in the option. Just a tenant, no purchaser's interest whatsoever. And purchaser's interest is basically a legal term that says that yes, they have the right to buy the property, not just the option to buy the property. They can buy the property and we can't stop them. So they don't have that. That's important. Number two is he has been advised to seek independent legal advice with regard to all leases, option agreements, and other contracts or agreements, whether written or implied. So here's the cover our butts section where we make it very clear we have advised them to see a lawyer, and if they didn't, that's their problem. And these terms are both initialed by the tenants, so it makes it extra clear that they have seen these and read them. So the optionee understands that the date for commencement of the lease is subject to change due to possible delays with the purchase of the property, including but not limited to mortgage financing, title conveyancing, document delays. The optioner shall not be liable for any damage, inconvenience, or additional costs caused thereby. The optioner recommends that movers, deliveries, and utility connections be scheduled for after the optionee's possession date due to potential delays. So remember, in the lease, I did have that little bitty section that says possession day is not guaranteed, and we're not responsible if you don't get possession on that day. That's about all I can put in the lease, because I don't want the lease to connect to the option. So now in the option disclosure, I am very clear about, here's why you don't want to book your movers. Okay, so it's, again, gives that extra information, pulls it all together. The optioner recommends all optionees maintain sufficient life insurance policies in order to allow any outstanding debt to be paid in full and to allow the option to be exercised in the event of the death of an optionee. So just imagine you've got this couple, they've paid $30,000 to rent to own this home. One of them dies, the other one can't qualify. Now they have to move out. So on top of a loved one dying, now they're homeless and they're out $30,000. That is not a situation we want to see. So we want to recommend that they have life insurance so that if somebody dies, they can just buy the property outright. In the event the optionee tenant is unable for whatever reason to exercise the option to purchase before the end of the lease term, the optioner may, but is not obligated to grant an extension. The reason this is in there is because if the tenant is not doing what they need to be doing to improve their credit, or maybe they're paying late all the time, or they're not taking care of the property really well, if they're not working towards home ownership, why would we extend? So that just makes it clear that we don't really have to. So they better try to purchase it, is what I'm saying. And as long as they're trying, we would have no reason to not extend. Providing that both parties, optioner and optionee, agree to extend the term of the lease and option agreements, the following must be understood and acknowledged. The final purchase price will increase depending on factors including the length of the extension. The monthly rent payments may increase depending on the prevailing interest rates, taxes, and other costs involved. The length and terms of the extension of the lease and option agreements are at the full discretion of the optionor. And the optionee is under no obligation to accept the extension. If the optionee does not accept the extension, then the option and lease will expire. So for example, let's say that now the market is taking off and it's expected to go up 10% this year. Well, I am going to increase the price by at least 5% for this renewal. If the tenant says, no way, I don't want to do that. Well, okay, you don't have to accept it. You can choose to walk away if you don't like the final price. But if I was selling it to somebody else, I'd be able to get way more. So I'm not going to just, accept something ridiculously low just because they can't buy it yet. So, and of course, we're always going to try to work to an equitable solution, but it's got to be in there that yeah, it's going to go up. And if you don't like it, you don't have to accept it. You can leave. So it's all covering our butts. The optionee tenant hereby understands and acknowledges that mortgage rates, terms, and rules fluctuate and may be otherwise amended by either financial institutions and/or government bodies. Furthermore, the optionee understands and acknowledges that such fluctuations and amendments may result in mortgage payments that could be either substantially higher or substantially lower than the rent payments paid under the lease agreement. So that's in there saying that yeah, rules can change. We can't help that. And you have to accept that that's a possibility, which also may mean they can't qualify. But the second part about the fluctuation of payments, because so they have to acknowledge that if rates go up, then when they buy the house, their payment could actually be higher than the rent they're paying. And likewise, their monthly payment could be so much lower that they might be thinking, oh my gosh, those people were gouging us for the last 2 years. No, we were basing our costs on what or your payment based on what our costs were. So that just sets that up. And if they have any questions, now's the time to ask before they get into the deal. And signing of the lease and option to purchase agreement in no way guarantees that the tenant will qualify for a mortgage or be able to obtain financing to complete the purchase of the premises. So again, we want it all laid out for them. Super clear. It is the tenant's responsibility to obtain adequate financing to complete the purchase transaction. The tenant's overall financial situation at the time of purchase, including employment, credit scores, any additional down payments, as well as interest rates and the state of the economy, will be determining factors. So again, it's all these external factors plus their situation. That has nothing to do with us. The optioner recommends that the tenant pay the rent on time, pay existing debts, including any collection items, consider applying for a prepaid or secured credit card to establish or reestablish his credit history, and to do everything he can to achieve a good credit standing to be able to fulfill this agreement and purchase the property. The optioner recommends that the tenant start the process of obtaining financing for the property at least 6 months prior to the expiration of this agreement. Now, we're not saying apply for a mortgage 6 months in advance. We're saying start chatting with your mortgage specialist 6 months in advance, because for some people, it takes them a lot of time to get everything together, or maybe there's something they didn't even realize that they missed that could be a roadblock. For example, filing taxes. Every once in a while, somebody will file their taxes late, and of course you need your taxes to be filed before you can apply for a mortgage. You need that notice of assessment. So that's the sort of reason why we want people to start chatting with the mortgage broker at least 6 months prior, so that they know what they need to submit. They can start preparing and getting everything lined up. If the tenant is unable to obtain financing, and as long as he is in good standing with timely rent payments, the optioner will consider renegotiating a new lease agreement for up to an additional 2 years and will honor all accumulated option credits towards the new agreement. And this is in there because we want people to feel comfortable, because sometimes they think, well, what happens if we can't buy when we're supposed to? Are we out all this money? Is it done? No. So that's why it's in the disclosure that no, your option payments are safe as long as you're working towards the purchase. And the optioner will, when possible, attempt to assist the optionee to complete the option to purchase by periodically reviewing the tenant's credit reports and making suggestions. To facilitate this, optionees must periodically provide the optioner with current copies of their credit reports, including scores. This is in there written a sort of sneaky way, because originally we had it where it just said you have to provide us with credit reports, and we actually had one tenant not want to provide us credit reports, and we don't know why. Yeah, they refused. So we put this in there because we want to be able to demand that they provide us credit reports, but it's in there written to show them why, because that is the reason why. We want to help. We want to review and make suggestions and make sure they're on track. So that's why we're requesting the reports in the first place. And so we wanted to make it really clear and friendly as to why we're invading their privacy. So goal number 1 of the option disclosures addendum is to cover your assets. That is the goal number 1. That's the biggest reason for it. Now, question here, have you had a problem as rental rates escalate quickly to demonstrate paying market rent? No, because it's market rent at the time the lease was started. So it doesn't matter as long as we can prove that that was market rent. So that's again why it's best to have the professional certified appraisal to prove that, oh, market rent when we started this deal was $2,000. So we've been charging $2,000. Now market rent is $2,800, but they're locked in at $2,000 because that was market rent at the time. So that is not an issue at all, as long as you have proof that you started at fair market rent. Now, these credit improvement suggestions are in the option disclosure. General suggestions the optionee should consider are: no more new debt, make all payments on time, check credit reports for any errors and contact the creditor to resolve them, check the limits on all accounts and ensure they are accurate. If a limit is showing as lower than it actually is, it could make the account appear overdrawn. Try to keep balances to less than 30% of the limit on revolving accounts, credit cards, and lines of credit. Check interest rates on all accounts and try to negotiate a better rate. When possible, make extra payments on higher interest rate debt first. So that's looking at both revolving and installment, because sometimes installment loans are way higher than revolving. Like if you've got a line of credit, not a credit cards, of course, are high. But while trying to increase credit scores, one should focus more on reducing revolving credit cards and lines of credit to 35% of their limits. Well, 30 is what we're aiming for, but at least down to 35 of their limits rather than prepaying installment loans. So, for example, when I graduated university, my student loan was way higher than what you would be paying on a line of credit. So a couple years, or I guess about a year after, the interest rates went down and my installment loan, student loan, was way higher of a percentage than a line of credit would be. So you would first want to pay the higher interest just to save money, but if and bring the debt level down as a whole, because that your payments and all that. But if my line of credit was maxed out, then even though it's a lower interest rate, I want to bring that down to at the most 35%. Depending on the number and type of credit accounts one has, close accounts that are not being used. Points may be lost for having too much available credit. If the optionee does not have a credit card, he should consider getting either a standard card or a secured credit card, such as a Capital One card. Use it every month and pay it off in full and on time. When accounts are closed or paid, pull credit reports 2 to 3 months later and make sure the change is reflected. If not, phone the creditor and get them to report it to the bureaus. Remember to focus efforts on the debts of the primary mortgage applicant first, usually the person who makes the most money. And just a quick visual of credit scores, they say that this site says 630 is a fair score, 690 is a good score. And so that seems to support this whole idea of 650 being kind of a magic threshold. It's not set in stone, but at this time, it's about 650 is the line between 5% down and 10% down. But that can always change. So that brings us to goal number 2 of our option disclosure. It's detailing the risks and consequences and listing suggestions for credit improvement. Establishes a rent-to-own operator as responsible and ethical and making all reasonable efforts to set the tenant up for success. So that is goal number 2 of why we do it. Now, certificate of independent legal advice. Of course, we want the tenant to consult a lawyer to make absolutely sure they understand. But whether or not you make that a firm requirement of the people who are dealing with you, that is, wait a minute. Oh, good. I just had a nightmare that the recording wasn't going, but it is. Okay. So whether it's a firm requirement for you to have of your clients, that's up to you. I'm personally happy with the option disclosure saying we have advised them, and so if they chose not to, that's up to them. Now, yes, and the option disclosure form proves that we recommended that they seek independent legal advice, and that's the real key, is to prove that we recommended it. And remember, it is the lawyer's job to ensure the client understands what he's getting into. It is not the lawyer's job to advise the client on, oh, this is a really good idea, or, oh, I wouldn't do this. That is not the lawyer's job. And that's why we want to refer them to our lawyer. And although this has to do with insurance, I just find it funny. Let's see, house, car, and did you want to cover your ass? Yes, I do. Thank you. All right, so here's what the certificate of independent legal advice looks like. I, Mr. John Lawyer, barrister and solicitor, do hereby state that I had been consulted by Mr. and Mrs. Sam Tennant, the optionee, with respect to an option agreement for property municipally described as address and legally described as plan block lot. I have examined the option, explained to the optionee their rights under the option, and further explained and confirmed that the optionee understands they are a tenant with an option to purchase the above described property. I have also advised the optionee specifically that they are not a buyer with equity, nor is the optionee creating any equity or any rights other than those as set out in the said option. I further explained to the optionee that Any lease agreement and any option agreement individually or collectively are not a real estate purchase contract or any form of purchase agreement. So the reason why it's good to get this signed is because it is very specific as to what they were advised on. And so this also instructs the lawyer, here's what you need to make sure they understand. That is the most important part. All right, any questions?
Do you usually use your own mortgage specialist, or do you let the tenant buyer use their own?
I always recommend that they go see my Jenny, because she has done so many clients deals for me that I know that she knows how to present it, how to get it done. And I don't currently have a mortgage broker that I would recommend to people. I had one that was fantastic, and then she retired to focus on her own investments. And since then, I have not found a mortgage broker who was really good at handling rent to own files. So I always recommend people work with Jenny, and she can work all over Alberta. So it doesn't matter if they're in Calgary or Medicine Hat or wherever I'm doing a rent to own. So because it's more important. I mean, some people will still want to go to a mortgage broker because they're chasing the best interest rate. But have to make sure that we inform our clients is that it's not about getting the best interest rate, it's about getting the financing, because these people are, first of all, sometimes credit challenged, they don't have a huge down payment, so they've got things against them. And then also it's a rent to own deal, which makes it more complicated. So it's just better to work with somebody who can get it done rather than chasing a 0.25% interest rate. So,
Yeah.
but some people still want to try through a broker, and I really wish I had a broker I could recommend to them. But yeah, every person who's tried a broker that I haven't recommended has not worked out. So that's why I still don't have a broker that I can recommend to them, because none of them have been able to do it.
Okay.
Yeah. I was talking to a broker that I deal with, and he was saying that I should submit something because there's a possibility you can freeze the rates. So that's another good reason for them to start talking to a broker about 6 months ahead of time.
Oh, good point. Yeah, exactly. Yeah, and if they do get the application actually approved earlier, then they can still, they've got that rate locked in, but if the rate does happen to go down, then they'll get the lower rate. So yeah, if they can actually get the application approved early, then that could be a bonus for them.
I was wondering, go ahead, sorry.
So I was looking at the resources from, I think, the last module, and one of them was the instructions on how to kind of read the credit and determine if their credit is on par. Is that also something that the mortgage specialist would be able to assist in, looking into? Like if I was friends with my mortgage specialist?
Yeah, well, yeah, I'm professionally friends with my mortgage specialist, and she has been really helpful. But like I say, she's had so many deals because of us that she goes out of her way to be helpful for us and will consult with clients, and because most of the time she ends up getting those clients. And as I say, sometimes people will still go off and try a mortgage broker, but inevitably they all go back to her because she gets it done. So yeah, she's definitely willing to because a couple times I've had an application where I've just looked at it and I thought, oh, this one's a little complicated with the fact that they're self-employed, especially if they're self-employed. That automatically complicates it. So the fact that they're self-employed and then here's their issues in the past for their credit, and I'm just not sure how long this person might need. So that's often where I'll consult her. But then yeah, when we have tenants that might need a little bit of a helping hand, then we'd say, yeah, if you want to talk to Jenny, then because she'll be there when you're ready to buy. You can talk to her now and make sure you're on the right track. So that's how we frame it.
Awesome.
I was wondering on the purchase price, Have you ever seen anybody try to index the present price forward? Like, say, well, the final price will be based on the escalating it based on some, like the typical house price that they come up with on the, like you have your medium house price, but then you have your, what they call the weighted or
No,
model
because
house.
because what we're starting out with is so if it's tenant first, we're starting out with the actual purchase price, and then what we so then we're going for an annual appreciation of something we feel is fair to both of us, something that's going to make us enough money and be worth our while, but something that's going to be easily achievable by the market, so that when the person goes to buy, that ideally they're going to get some free equity, or at the very least, the property will be worth what we're charging them. So that's what we're aiming for. And now we have had a couple people ask us, well, how did you arrive at that? And then what we say is, well, we follow a lot of economists, and based on what the economists are saying, what the local economy is doing, as well as what the housing market is doing, we feel that this percentage increase will be easily achievable during this time. And so that's why we're going with that. And yeah, we've never had any pushback on that. I don't recall anybody ever trying to negotiate us down. No, because we are aiming for something fair to both of us. And if somebody is concerned about it, then so they may ask, well, what happens if it doesn't work out that way? And then it's, well, we look at that on a case-by-case basis. And so if it turns out that the appraisal doesn't fully support the purchase price, then we look at that time, because in the end, we want you to buy the house. We don't want it back. So we're gonna do everything we can to make sure you're able to buy this house. And that usually resolves their concern.
Okay.
Regarding the penalty, so I guess if it's a property first, you would aim to align the closing date obviously with the tenant buyer's capability, but you try and line it up to kind of be in line with the maturity of your term that you're in, I guess, currently.
Ideally it lines up, but first and foremost, we want that good quality tenant, and we're going to consider their needs first. And if we end up having to pay a small mortgage prepayment penalty just because we've got this right tenant, whatever, we're still making way more money than if we had just sold the property today. So the fact that there could be mortgage prepayment penalties in a property first, I don't worry about that. The most important thing is finding that person who is a quality prospect who will likely be able to buy the property. And then, yeah, if it looks like they might be able to buy in 2 years and our mortgage is 4 years, I'm still going to set it up for 2 years.
Okay, and then with tenant first, you could kind of adjust it accordingly as well.
Yeah, so with tenant first, there's 2 ways you can do it. And it really depends on, like, for instance, when it was really low interest rates, well, then what we were generally doing was setting up so we would determine what the tenant's term would likely be, and then we would get the same mortgage. So if we figured it was a 2-year term, we would get a 2-year mortgage. But it really depends what the rates are doing, because there were a couple. And part of the reason why you want a fixed mortgage when you're doing a rent to own is because you're tied in for 2 years or whatever it is. Usually it's 2 years. So you don't have the option to increase the rent after year 1. If it's a variable rate and the rates go up, you're stuck with what you've got. So that's why generally we like to sign in for a fixed term with tenant first that matches the mortgage term, matching the tenant's anticipated term. And then if they do need to renew, then often the best idea for renewal is to renew into, and it really depends on the situation, but often the best idea to renew is into a variable, because it's really hard to anticipate how much longer they're going to need. Because in one case it was oh, they just needed 6 more months, or was it 3 more months? I think it was, oh, we just need 3 more months. So I left it open, and oh, then it was 3 more months. Oh, okay, well, it's still open. It ended up being, I think it was almost 2 years that we had an open mortgage, and we
Wow.
would have saved about $8,000 had we done variable. So yeah, for a renewal, so with tenant first, you match the fixed mortgage with the tenant's term. If there's a renewal, often it's a good idea to just automatically go into variable, and then you're going to have a 3 months interest penalty, but at least you're paying a decent interest rate and you've got that flexibility rather than open. Don't renew into
Okay.
open.
And you would normally do tenant first with an uphill market.
Yes, yes, a
You wouldn't
rising
want to do
market.
it if it was flat neither, right?
But if it's flat, but it looks like it's ready to take off, and the thing is with tenant first, you won't really have many inquiries for tenant first until the market is starting to pick up anyway. And
Mhm.
with property first, you will, if it's a flat market, you'll have some inquiries. It will take longer to find people. You'll have lots of interest once the market starts picking up. The thing with property first, though, is of course you don't need to charge as much, so it's still attractive to people, even if it's a flat market, because you can leave the price the same as today. You don't
Yeah.
have to have it marked up. So
Okay.
yeah, it works either way.
In this market now with the rental going up so fast, some people might want to get into rental and just to freeze the rent. So
And the nice thing about it is that if you have a fixed rate mortgage, you know what your costs are. The only thing that will go up is taxes a little bit, insurance a little bit, but your major expense is the mortgage. So if you're in a fixed mortgage and your rent is covering it, then it doesn't matter if it's 1 year or 3 years, because your costs are covered, you're a positive cash flow that whole time. It doesn't matter if the rent's double because your costs are staying the same. So yeah, that's a big reason why we usually prefer fixed term mortgages when we're doing tenant first. Now with property first, it depends on what is already in place. You just go with that. So yeah, property first will be a little bit different because you might have had a variable mortgage when it was a regular rental and that was working just fine. Well, now you could lock in if you wanted to. That's one possibility. But yeah, you could just leave it variable. It really depends on what's happening. And then the other thing is, if you're getting a property on agreement for sale, well, it's whatever the other person signed for. So you don't get to choose what the mortgage is. It's already there. So as long as the numbers work, then you're good to go. All right. Does that about cover it?
Yep.
Okay. So in the portal, all of the contracts, of course, the replay will be there within the next couple of days, copy of the slides and the transcripts. And next week, we're talking specifically about tenant first as a business. So we'll go into all the extra details about tenant first. And that includes the rent to own worksheet where we figure out, oh, okay, play with the numbers, see how we can make it work. So we'll go over that, and also working with joint venture partners and some specific things to do with rent to own as opposed to regular joint venture partners. And that is it for today. So I will see you next week, and thank you for joining me.
thanks. Night. Good night.
Enjoy your night.
You too.